Thanks, brother. All right, guys. Hey, welcome. We'll start off with a cozy little group today here, but hey, glad to see some new faces here. Matthew, you're always on, so hello again, and hope you're getting to learn some stuff. Jason, we got to meet you a little bit there, and Mark, I don't believe I've seen you on here in the past, so welcome to our call tonight. Hopefully you can gain some value and maybe we can kind of get some banter going on back and forth as well in the end. So welcome to everybody else that joined. We're just getting started. And so let's kind of go through this. So this is multifamily napkin underwriting. It's a Zoom. It's kind of quickly become a little bit more than just napkin underwriting. We kind of go through the fundamentals of underwriting, although we're not yet putting things into a full-on calculator or analyzer. But we do review some of the fundamentals and also how to quickly tell if the deal is a stud or a dud. And so Ed Shamirian is typically on with us tonight, but he's got a lot on his plate. So Will and I are going to do our best to cover for him and see what we can provide tonight. So with that, we have an agenda. We keep this to an hour flat. And last time we experimented with a little VIP session, not VIP, it was an after party session. We'll call it an after party. So I don't know, maybe that'll become a theme into later weeks, but tonight we'll keep it to an hour. We're gonna go through the introduction. We're gonna review the ecosystem. So those of you who are new can look and see what the freedom chasers are about. We're going to talk today about the exit side of the napkin underwriting, just a little bit of a topic there. And then we're going to grab our napkins and we're going to go through some deals. So if you have a deal that you might want to slap in a napkin and kind of see how it works, let us know. We'd be happy to run that for you. And of course, Q&A. With that, Will, you want to tell them who we are?
Sure. Well, hey, welcome everyone. Good to be with you all this evening. My name is William Otis, and I am here with my ride or die partner for 15 years, Aldo and Chetta. We are from Chattanooga, Tennessee, and we're just a couple of dudes that are dads. Aldo has 2 kids. I have a daughter who's 4 years old, almost. And we actually cut our teeth in the senior living space. Collectively have about 25 years of asset management and operations experience. We still actually work in the senior living space. I'm vice president of operations for a company based out of Knoxville, and Aldo is our director of asset management. But on the side, we love to do multifamily real estate and purchased our first couple deals about 10 years ago and continuing to grow that portfolio. And so we're just excited to be here this evening to share with you guys and to hopefully get to know each other a little bit more and hear a little bit more about what you guys are up to. And this is this is a great community. The best part about it is it's all free, and to continue to grow in real estate and find meaning, purpose, and joy in everything that we do, and specifically through real estate. So glad to have you guys, and I look forward to being here. Ed is from Los Angeles, and unfortunately he's shown some of his apartments this evening. He's doing some showing, so he's not a little bit about you. I know, although you called out a few new names, I think this evening. Jerry Miles is here. Good to see you, Mr. Jerry, and Billionaire Pete. Good to have you guys both here, both leaders in the multifamily freedom chasers community, and so we're glad to have you guys here this evening. But let's see, would love for anyone who would like to introduce themselves to raise their hand. Feel free to raise their hand. If not, we'll start calling on a few people. I was going to call on Jason, but I see he just went off video. So, but if
I'm sorry, I'm having lag issues. You were
okay, man.
I'm still here.
All right, good deal, man. Tell us a little bit about yourself.
Well, my name is Jason Jameson. I too am a father of two children, husband of one. And originally from Pittsburgh, Pennsylvania, joined the military in 2004. I was in the Navy. They stationed me in Virginia Beach, where I lived for 15 years before I moved out here. I got in a single family in 2007, did several flips, about 24 flips. I did a few rentals, all in a single family, got into multifamily a couple of years ago. Just started my own business in December, and now I'm working to get my own deals. Well, not mine, but I have a team of people that I work with, so our own deals, I should say.
Love it, man. Well, hey,
And
we're glad to have you here. You said that you partner with Elise.
Yes.
Okay,
You
good
know,
deal.
I don't know if you remember her.
Yes.
Oh yeah, of course. Yeah. We've had several conversations with her. So she's in Ohio, if I remember correctly.
She's in Indiana, but it's right on the border with
Indiana. Okay, that's what it was. I knew it was kind of up in that neck of the woods. So, well, awesome, man. Well, hey, good to have fellow fathers here. Congratulations on starting your business here just recently.
Thank you.
Appreciate your service as well, and glad to have you here this evening. So,
Thank you.
anyone else? We probably have enough time for maybe one more this evening. I see Mark Jean on here. I know you're driving, man, but feel free to unmute yourself.
Yeah. Okay, I just did. I just realized I could unmute myself.
There you go.
Yeah, I'm here in Los Angeles, and I'm driving to my son's basketball game. He's got a summer league that he plays in. But I kind of got connected through Carlos, I guess. I met someone through Carlos, and currently I've invested in Cardone Capital and a couple of their funds, and just looking to put my own deals together. So I've been putting a team together out here in LA. We've been looking at property in Texas and Austin specifically, and Houston. And so just really wanting to learn more about underwriting, to be able to do like the back of the napkin kind of underwriting, because that's I think something that'd be very helpful to be able to evaluate properties. So I'm grateful to be here. Glad you guys put this on, and looking forward to learning.
Yeah. Hey, man. Well, welcome. Glad to have you here, Mark. Too bad Ed's not here, because he's in your neck of the woods as well, right out there in LA. Actually, I don't know if you were on last week, but the after party was about a deal in LA. And Aldo and I, not sure we ever want to invest there, but hey, kudos to you guys to potentially pick up some deals out there. But man, it's definitely a different world. It's not Chattanooga, Tennessee. I'll say that.
It is. It's completely different. It's like, the only thing I do is look just to gain experience. But our main goal is to invest in Texas right now.
Well, yeah, great markets in Texas. But man, we're glad to have you. Welcome. And Carlos is phenomenal, and we love Carlos here at MFC. So we're glad to have you here.
Thank you.
Awesome. Thanks, Will, and get to meet you guys and everyone else that's been jumping on here lately. Just a quick overview of what the ecosystem entails. This community is called the Multifamily Freedom Chasers, and it was founded by the first three Freedom Boys, Marcel, Trevor, and Victor into the G. And they've done a lot for this community, and it started off with just them trying to keep each other accountable, but it quickly grew to an entire family, and I call it a family on purpose, because that's really what we are. We're just, their vision was, to be able to help people that were, in a W-2 professionals that were in the grind day to day, but wanted to chase freedom through real estate. And so that immediately resonated with myself and with Will. In addition to that, having all kind of other responsibilities like family, local community involvement, etc. They started this whole thing in order to be able to help those types of people. And so on Sundays, they put on an activation Zoom with some great celebrity guests, and it really is an activation Zoom, and I've learned a ton, and there's a lot of mindset talk on there, but there's also a lot of motivational talk, just seeing where people started and where they ended, and to see that it's attainable as well. So, and then of course on Mondays we have broker talks with Peter St. Martin, who's on here tonight, and also with Ed Shamirian, who typically is on with us tonight, and they talk about how to talk to brokers. What you need to find a deal, and in order for you to do that, you need to be able to talk to a broker to be able to get a deal. And so there's a lot of really good stuff that goes on there, a lot of role play, and also a lot of kind of looking at what do they call it in sports when they look at reels, and when they look at tape, a lot of watching tape of some of these professional people. And Pete's a great person to do this too, when they talk to brokers, so that you can get comfortable with the lingo, and also with the things that you need to find from brokers. And so once you find a deal, bring it here, and then we help you do some quick napkin underwriting, and we show you the ropes on some of the fundamentals of underwriting, not just napkin underwriting. And by the way, there is a lot of, I don't know if you can find the YouTube channel, but there is a lot, or Peter, if you have it handy, there's a lot of really great stuff in our YouTube channel, and it dates back all the way to October, November, where some of the team put on, Victor actually put on some really great underwriting Zooms. So be sure to check that out. But once you have this deal, well, you need to, one of the biggest parts of the deal that you makes or breaks it is your debt. And so on Wednesdays, alternating Wednesdays, we have Jerry Miles, who is here with us tonight as well, and his family put on a debt Zoom. They go over the current state of the debt market. And they also, thanks Matthew, appreciate that. Current state of the market and several other different topics around that, for us to be able to understand what we're getting into on these deals. And so an incredibly useful Zoom. You all would find it very informative. And then on
register for that?
Yeah.
Thank you.
Yeah, you absolutely. And so the way you register for that is just join our Facebook group, and you'll get all kinds of invites for that.
Right now.
And so, yeah, absolutely. And Jerry, I don't know if you have it available or something. Maybe we can drop those Zooms on the chat as well. But then, alternating Wednesdays, we have Victor into the G, who goes over a more advanced underwriting. It's more like underwriting 405, or it's really like market analysis, and it gets really deep into the macroeconomics of things. And so it's also a really great one. But with that said, this is the ecosystem, and the goal here and the mission here is to be able to give you guys the tools to be able to learn enough to be able to then take the next step, and then get into the mentorships, and then get into real estate. And so that is our ecosystem. This is our contact information from an email standpoint. Also, we have, or at least Will has it. I don't, his cell phone, and we'll drop our IG handle as well on the chat. But if you have any questions around napkin underwriting or not underwriting at all, please feel free to send us, an email and ask us about whatever deal you want to look at. We'd be happy to look through it with you, give you our opinion, and yeah, however you want to handle that. So with all of that said, I'm gonna go ahead and go through our topic tonight, which is the exit side of the napkin underwriting tool. So by the way, all of this that we put on, for those of you that are new here, is completely free. And we have never charged, and will never charge a dime for any of this education that we put on. Additionally, we have put together this napkin underwriting tool to help evaluate deals quickly, and it's free. And I'm pretty sure Will dropped it in the chat earlier. Yes, and so we go over this. This is the tool that we used to underwrite on this Zoom anyway. And so on the left side of the tool is the inputs for the current, basically for the current performance of the assets. And then on the right side of it is basically our estimation of when we exit, or when the asset reaches stability. And then, of course, we have in-place rate data as well as market rate data that we get. And then a couple of other things on here that we'll go over once we do a deal. But today I want to focus on the exit side of the napkin underwriting. Last week, we went over, this part of it, which is pretty simple. And it really is essentially the same thing, except for the valuation at the end. So it would be essentially the guess or the educated guess at the end of the term that you're holding this asset for, as to how much it's going to value itself at, right? And so for that, we need, several different components of information. First, we need its current performance, right? And so we're going to need average rents. You get that from the rent roll. You're going to need total number of units. You're going to need the occupancy percentage. So you put all of that here on this side. You put the asset class in here, and then it's going to shoot out an NOI and then a valuation based on the asking price for that, right? And so this side of the napkin is based on the offer price, or not the offer price, the whisper price, right? And so once you put in all the information, it's going to kick out a going in cap rate. And so the reason we did it backwards and not necessarily calculating the cap rate ourselves is for us to understand where this deal falls from a going in cap rate standpoint. And we can go over that a little bit later. That's not the focus of tonight. That's just a really quick overview of that side. Typically I spend a lot more time going over that, but just for you guys to know and understand kind of what is entailed here, right? And so on this side, you have the in-place information. On this side, we have the exit information. And let's just say, for the sake of this deal, for example, the thought was, okay, average rents right now are $1,200. We can bring them up all the way to $3,200 just because of the market conditions that were going on. That 1.8 cap rate, that's just part of the example, man. The 1.8 cap rate is essentially just a function of the NOI and the valuation price, right? So cap rate in this situation being the technical term of capitalization rate, which is essentially just the unlevered returns on your investment. So for however much you paid for it. So in this example, if you paid $2 million for it and your NOI is $35,000 a year, then your cap rate going in, your cap rate for that is 1.8%. Right? And so that's what that means. So if you paid $1 million for it, or 100,000, sorry, $1 million, then that jumps up a little bit, right? So it's all based on your cap rate. It's all based on the performance of
So
the
that's
app.
not market cap rate. That's your cap rate. Okay, got it.
That's
Thank you.
correct. Deal cap rate, I guess, or going in cap rate. And of course, a lot of this is, there's a lot of different variables there, but. So that's a calculation. So anything in blue you put in, anything in black is a calculation or a formula for it to tell you. So, and then we move into the exit part and we say, hey, we can get $3,200 for these 6 units, and we can get the occupancy up to, 100%. And this was actually 83 because it's a 6 unit. And it was 1 down. So we can get it up to 100% at $3,200, right? So let's then go through each one of these. And so what does that mean? That means that we can, at stabilization, we can bring the income to $230,000 a year. As a C class rule of thumb, not saying this is always the case, but rule of thumb, expense ratio being an estimated 50% of your total income. That brings you to an NOI of $115,200. Okay, so this cap rate right here that we're calculating, right? It's basically the cap rate based on the purchase price, right? How much has your cap rate grown, or your return grown, or your NOI, better said, how much has your NOI grown over the years? How much, by your efforts, by your, excuse me, by your asset management efforts, right? In bringing up the rents and, keeping your expenses stable. So we went from this NOI, say $35,000 or $36,000 a year to $115,000 a year. As a function of the price that you paid for it, you go from a 1.8 cap rate. This is just an example, by the way, to a 5.76 cap rate. So for this specific cap rate right here, you want that to grow because it shows you that your returns for the amount that you paid for this deal have increased. And that's good to know. Then the next one here is essentially a calculated sell price based on a market cap rate or an exit cap rate, right? Which in this case, for this market, the folks were thinking it was about a 4.5% cap rate, and it was an A class, actually. It's an A class. That changes things a little bit. Right. So, an exit cap rate it's an interesting one, right? Because there's market cap rate, and then there's exit cap rate, which is essentially a guesstimate of where the market cap rate is going.
What's your hold time?
I think we might have lost Aldo.
Okay, I thought it was
So
me.
I think the whole time on this was, no, unfortunately, I think we lost him.
Okay.
So,
Back?
He's back.
yeah, there you go. I think you're back now. I
Okay.
believe the whole time on this, Aldo, do you recall the whole time on this one? Was it 5 years?
It may have been about 5 years. So yeah, because, well, I think in talking to, I think it was 5 years. Because rule of thumb on this, right, is 10 basis points per year. Increase 10 basis points per year off of the current market cap rate, I believe. And so, I think it was at a 4 and then went up to a 4.5.
Thank you.
Yes, sir. And then you get an upside number here, and it's all based on how much you paid for it too. So you get like a true up, no, it's almost a true upside amount.
Do you mind me asking questions?
Not at all.
Okay.
No,
You do.
please carry on. And so what this does not include is any rehab costs that are an estimate here, right? And so that is that. So these numbers here are from another deal that we did. We just didn't change them. This side of it can really help you get a weighted average in place rate for your deal so that you can put it in here, and then you can measure market rates and get the same to put it in here on this side, right? So that's the exit side of the napkin underwriting. Do we have any questions on that so far? Great. There's also a little debt overview here, and it kind of gives you an idea of where your DSCR might land, or your, based on your LTV, your leverage, and interest rate. And Jerry, if I'm not mistaken, we're getting beat up pretty good on the rate side here. Maybe today's announcement was helpful. I don't know. I think they just started their meeting, right? They haven't finished.
They're supposed to talk about it in the morning as far as what they're going to do with the rates. I mean, what a lot of the experts are saying is a pause this month, maybe a little bit of a hike next month. Yeah, nobody knows.
Or
Yeah,
your your DSCR would be really low in this purchase. Do you think you'd actually be able to get a 70% LTV?
oh no, this is absolutely a ridiculous deal. I mean,
Okay.
yeah, this would have to be like it'd have to be backwards, and even then, yeah, no. This is just an example.
Okay.
Yes.
Thanks. It was hard to get that in my head. It's in there now.
Yeah, absolutely not. No, you have to be pretty dang desperate to get that on there. So when we do an actual deal on here, you'll be able to see kind of what comes out of there. There's a little bit of a returns table here as well, just for you to kind of have an idea of what year one and stabilized look like. Yeah. So, okay, great. Any other questions before we try to see if we can't put up a deal here? Cool.
Did a great job so far.
Yeah, awesome. So we're gonna look at a deal that Will and I agonized over for, Lord, 4 months.
Yeah, we can do that. Before we jump into that, does anyone have
Yeah.
a deal that they want to bring to the table tonight? And again, this is all confidential. You don't have to tell us where the asset's located or anything. We're really just looking for some numbers that we can plug into the calculator to help people learn. But if no one has anything, yeah, I'm happy to bring up a deal that we looked at in Alabama. So I'm not sure if anyone has one that they want to present tonight.
Cool.
All right, so looks like we're going to Alabama.
Let's go. Sweet home Alabama.
Alabama, brother.
So average rates here were, I'm trying to go off of memory here.
700 a month.
For 56 units.
52.
Oh man, terrible memory.
Come on, brother.
It was not 90%, but that was the contingency. So we're underwriting at 90%. Definitely a C class. But a pretty fairly renovated C class. So not a whole lot that needed to get added on. I don't even think we're looking at that much. Oh, wait a minute.
For CapEx?
Yeah. I changed that.
Yeah, the asset was pretty well renovated, had new roofs on the entire, I think there was 5 buildings.
Okay.
Where in Alabama, Huntsville or Birmingham?
I was in Birmingham.
Yeah. They took it off the market and everything.
Mm.
Yeah, radio silence from that broker, man. We told them too, it's not gonna trade. And it didn't.
It did not.
So let's see. They were asking
for 65 a door.
That's what we offered. Okay, so
We were just under that. Yeah.
Yeah, so let's just do asking. Okay. Expense ratio, probably could have been lower a bit too. The most, I think for all of them, tenants paid utilities, so that helped a little bit. Management fees would probably increase over time as we added some of the buildings into that. We were looking at almost $900 rents, right? It's like $850, $875 average.
Yeah, I think they had on the OM 823 average.
Yeah, I think we pushed that to $850. 95% occupancy. This is definitely, I think we were underwriting a 6.5 and maybe even a 7 cap on this conservatively. And at the time, that was what, like 5.5?
Yeah, around 5.5.
Right. 75% LTV, I think we were getting for that. This is, yeah, so let's call it 70. Close enough. Okay. All right, so you can see that this wouldn't work today just because the interest rates now are twice that, or a whole 100 points higher than that.
Although maybe it'd be fun to put in kind of more a competitive quote for today's, kind of where we're at in today's market, and then we can kind of work it that way.
Yeah, I bet we're looking at a 65% LTV with a almost 6.5 interest rate. And Jerry can correct me if I'm wrong on that. But it is grim.
I didn't hear you. I'm reading at the same time I was on here. So what'd you say?
No worries, man. No, I was just putting in some debt stuff on here. 65% at 6.5%. Does that sound about right?
You'd be safe there. This is a smaller balance loan, right?
Yeah, it is.
Under 6 million.
Mhm.
Yeah, you'd be somewhere between 6 and 6.5.
Yeah. So yeah, that's the deal. So what do we look at here to determine whether this is a good deal or not, right? So the first thing I'm going to look at is my going in cap rate. Okay, unlevered returns at 5.82%. How does that compare to my current interest rate? That's one of the first things that I go to. Okay, we are below our interest rate. That means we're what's called negatively leveraged. That means that it's not going to fly. First of all, your DSCR is below 1.25. That's not going to fly. And secondly, because your interest rate is higher than your going in cap rate, it means that you will likely not be able to cash flow. And if you cash flow, it won't be very much. So you really want to make sure that your going in cap rate is higher than your interest rate. We start looking at deals when it goes above, 50 to 100 basis points above the current interest rates. That's, got some meat on the bones. If you want to be a little bit more of a maverick, you can, get closer to, that interest rate. And if it's a really great value add deal, maybe it makes sense. But, we like to be a little bit more conservative, especially during these times of absolute variability. Right. So that's the first thing to look at. Next thing I'm going to look at is if we implement all of our value add strategy and we increase rents to this amount, what's my upside going to be here? Right. Well, right here, we're looking at, almost $500,000 in upside, which is not terrible, but it's not what we are looking for. We're looking for anything, $1 million and above. Now, if it was less, so if you have a quadplex making $500,000 in upside, I'd say that's pretty dang good, right? And so maybe something to consider. But if you're looking at a 52 unit deal coming up with $500,000, that's a lot of work for not very much, because at least 30% of that is going to be gone to your investors, plus any sort of preferred returns or split. So yeah, definitely something to consider.
And just something to add there. I mean, this is all relative, right? So we're very much so speaking from, how Aldo and I look at investing. And so your strategy may be completely different, and that's great. There's nothing wrong with that. This is just strictly speaking from, I guess, the way Aldo and I evaluate deals. So, love to hear other people's thoughts on that. Of course, Ed, who's also on this Zoom a lot with us, he's big time into creative financing. Aldo and I are a little bit more traditional when it comes to financing. And so, hey, I mean, whatever works, right? And gets a deal done. But again, this is just kind of what we personally look for in a deal. So
yeah, absolutely. That's a great point to bring up. And the point, I guess, here is, hey, this is the metric. That's the number, right? You do with it what you want. But it's just a way for you to have the number in your face to be able to make the decision of, and this isn't to make you decide to buy the deal or not. This is the first step in you realizing, hey, this could be a good deal. I'm going to take a deeper dive, right? If you're going in cap rate is higher than your interest rate, if your upside is acceptable to you, if you're looking at, rehab costs, and of course you also know what, how much rehab you need to put in there, what the market rates look like and everything, then, hey, it's looking pretty good. I think this is something that we might want to look at. And if it's close to that, then you can say, okay, maybe there's a little bit of wiggle room in this deal. And you can say, hey, well, what if we offer $3 million for this instead of $3.3 million? Oh, well, hey, that's a lot better. We're at least now meeting our interest rate here. Our DSCR is at 1.32. That's a good thing. Maybe there's even more wiggle room. Maybe we can get creative around this offer. Yes, Rosa, what's up?
Hey guys, just have a question. Can you simplify the term upside? What does that mean? Is that like
Upside? That's a great
great
question.
question.
Yeah, upside is basically how much money you can make out of this outside of cash flow, right? How much in your I won't call it upside strategy. You don't use the word to define the word. In your upside strategy, how much can you raise your revenue and thereby NOI so that you can have a chunk, an upside chunk when you sell it? So for example, you buy this at $3 million, right?
right?
You implement a value add strategy to bring your rents up and therefore your NOI up, right? You see it goes from 196 to 251, right?
Right.
When your NOI goes up, the value of your property goes up. And this is the math that is huge here, right? This is what they call $1 million math. And so for every dollar of NOI that goes up, depending on your cap rate, let's say a 5% cap rate, for every dollar that goes up at a 5% cap rate, that's $20 of profit, right?
Mm,
Of increased value, not profit, of increased value of the property, right? So if you're able to increase your NOI by $1, the value at 5% cap rate goes up $20, right? And so for here, we saw the NOI go up from here to here. We're underwriting our exit cap rate at 6.5%. So naturally, to get the value of an asset, you take its performance or NOI and you divide it by the market cap rate, right? And so that's what we're doing here. So we're saying we bought it at three mil. We're gonna put in a little bit of money. You sell it at 3.8. Your upside is $8 million. I mean, sorry, $800,000.
so that would be like the difference from when you bought it to the difference from when you sell it. Is that the difference?
That's the upside.
Oh, okay, perfect.
That's
Got it. Thank you so
Um,
much.
Absolutely. Now there's other costs involved as well. And so putting this into a bigger analyzer will really help. But as for right now, you're able to see it kind of, okay, I've got 800 grand to play with here, or I have 1.5 million to play with here, whatever. Will, sorry, were you saying something, man? Because you had gone out.
My internet is pretty unstable here in the hotel this evening, so I apologize, guys. But and Rosa, I just want to make sure also you understand what NOI is. Do you understand NOI?
The net operating income will be
Yes.
what the asset is, it's like bringing to the table with laundries and pet fees and all of that plus rent, right?
Yeah, so your NOI is your revenue minus all your expenses. That provides you your net operating income. And so that's probably the simplest, the easiest way to kind of understand NOI or net operating income is just revenue minus expenses. So just kind of help. Yeah, and that's the one thing different too, with especially, commercial real estate deals is unlike a home where you're going based off of, the value of, the property. Really what you're buying when you buy multifamily real estate is a business. And so that's where you really derive the what the asset is worth is based on how much money you're making on that asset. And so anyway, just wanted to make sure that you fully understood also what NOI is, because that's really helpful as you continue to move forward in multifamily real estate to understand, that you're really purchasing a business, and that business is valued based on how much money you're getting out of that property.
Perfect. Thank you so much.
Yeah.
Absolutely.
Great questions. I appreciate you raising your hand.
Absolutely. And Mark, you're asking about the rule of looking at a cap rate being higher than the interest rate and what the advantage from that is.
Yes.
Most people won't look at a deal if your going in cap rate is under your interest rate because you're negatively leveraged, right? So if your returns, let's go back to the cap rate, capitalization rate definition being the unlevered returns for a property that you buy, right? So meaning that if I buy this at 3 million and my NOI is 196,000, my cap rate or my capitalization rate or returns, unlevered returns are 6.55% in this case, right? So the previous one, it was less than that, right? It was 5 something, it was 5% something. It means that my returns or my NOI are less than optimal for the interest rate or the payment that I'm going to be making to the bank. So let's go back to 3 million.
Yeah, I think, the simplest way, Mark, to think about it is you're not going to be able to pay note on the property. You're not going to be able to pay enough revenue to really even pay the loan on the property. So hopefully that helps. Yeah, and Aldo, sorry to interrupt you there, man, but hopefully that helps explain it a little bit.
Yeah, you cut out a bit, but I think he got the main point. It's
Yeah. And
Yeah.
I mean, that's important because that's why we want to buy multifamily, is because we want that cash flow. And so that makes sense. So you just want to make sure that you're fine, that the cap rate exceeds whatever the interest rate that you're going to get on the loan, so that you know that it's going to positively cash flow and cover the debt.
That's correct. Absolutely.
Okay, I got you. Now, is there a case where you would buy a property that might be break even cash flow versus the interest rate, so that you can maybe where you have opportunities to force value into the property?
Yeah, absolutely. There is that. So there's the risk involved in that. So
Yeah,
there's definitely that. And just because your cap rate, your going in cap rate is below your interest rate does not mean that you will not cash flow. It's just going to be a lot thinner. And so you can see here, so another metric to look at here, and might maybe get too complicated. So feel free to cut me off again, Will, and explain it in layman's terms. But your debt service coverage ratio is essentially how much more NOI do I need to make in order to cover my payment and the bank be happy? Most of the time, for every $100,000 in debt payment that I have from the bank, they want to see me making $125,000 in NOI, right?
Yeah.
The rest of that is cash flow. The 25 grand is your cash flow. It's not very much when you're getting down to 125, you're probably looking at like $200,000-300,000 in revenue, and that's so makes
So, so Aldo,
yes.
how do you know if the broker is giving you the correct cap rate?
So that's a good question. So the cap rate I'm talking about right now, so there's about 7,000 different ways to look at cap rate, right? The that I'm looking at right now is solely based on what you pay for it, for the asset, and what the performance is, what the NOI of the asset is, right? So if I buy this property right now at $3.38 million, and my NOI is right now $196,000, my cap rate is 5.82%. So cap rate is another way to say returns, right?
Right.
Returns without debt. If I buy it cash, those are my returns, right?
Mhm.
And so, yeah, no, great question. And so, Mark, back to you. It's, you won't necessarily be negative cash flow or even break even cash flow if your going in cap rate is below your interest rate, but it's going to be slim. And maybe that is kind of where your upside is.
Yeah, so that's helpful.
Sorry,
Sorry. Yeah, that's just good to know, because it lets you know, I guess, if you're really in love with the property and really like it and see where it could be a year, 2, 3, 5 years down the road, it would allow you to make that decision
Mhm.
based on that. So that's helpful. Thank you. But go
Absolutely.
ahead.
No, yeah, and you have to play around also with your leverage, how much leverage you have on there, because the bank might want to have a specific DSCR unless you have a great relationship with them and you can get less than 1.2% at DSCR. Hard lender, or it's private lender or something like that. Yes,
Okay.
Jason, interest rates can decrease with a higher DSCR. Well, they can decrease with a higher DSCR or a lower leverage loan to value. Yes, they can. Because there's less risk involved, right? If the bank sees that you can cover your payment by higher amount, then they feel safe. If something happens and you make less money, they're still gonna get. It's all about the bank getting their money, right? So, absolutely, excellent point.
So really, we don't go by the broker about the cap rate. We can calculate it ourselves by looking at the rent roll.
I usually don't mess with the cap rates that come from the broker. They lay it out so nicely at this cap rate. Here's the value, here's that value, and all of that. We come back to them and just say, hey, look, this is our number based on the debt market. Forget your cap rates. Will, were you gonna say something?
Yeah, I don't know if you guys can hear, so I just typed it. But yeah, for the going in cap rate, at least, hopefully there's no brokers on the call, but it's usually BS. But it's great to get exit cap rates for the market from which will obviously impact your potential sale value in the future. But that's why we do napkin underwriting, is really to be able to evaluate the asset truly based on how it's performing, not what someone's telling you in an OM or whatever.
Yeah, absolutely. And also as well, maybe save face a little bit with the brokers, but they may not be wrong about where the cap rates are right now, or where most things are trading at right now, right? Because the cap rates are going to be a reflection, the market cap rates are gonna be a reflection of what's being sold currently, what things are trading at. What they won't tell you is the distress in the market, where interest rates are going and where that's driving the cap rates to, right? Because right now, with this interest rate environment, on a C class, a 7% cap rate is probably gonna be your, like, the bottom, the floor for you to purchase something, right? Depending on the market, et cetera, just because of a 6.5% interest rate.
Mhm.
Right, and so, yeah, so I never go first to cap rates when I talk to brokers. I ask for the guidance price, what the whisper price is. Okay, great, I have that. Now, first of all, can the rent support that? Okay, so I put in my rents. All right, how much are they spending on this as a percentage of their income? Okay, so they're good with their expenses or they're terrible with their expenses. So there could be some upside there. All right. So then I look at, okay, what do I think expenses can be here, right? Based on my understanding of the market. Okay, so I plug that in and then I get an NOI, right? And from that NOI is what I go off of. And that cash flow is what I go off of. So then I look at my returns from there based on the debt, right? On the debt amount. So I am looking at my returns and looking at my cash flow right off the bat. So once I have my cash flow, I know how much the return is going to be for my investments. And if that doesn't, or investors, if that doesn't make sense, it doesn't make sense. I don't care about the cap rate at that point. But typically it's going to be a lot higher than this.
Well, I just want to say we can't really trust the OM at all because they're,
The
they're
OM,
just making everything look so nice.
it is very,
So
a very
we
nice.
really have to do our work. Yeah,
You want these
Hey, Marcel.
brokers selling your property. That's what you,
yeah.
I'm Marshall Mohan here. Can you hear me?
yeah. Hey, what's up, Mohan?
Mohan, what's up,
I
bro?
joined a little late. Multiple things happened during weekend anyways. The cap rate which is showing here in the screen, right?
Yep.
So this is not from the OEM. So this is something which you calculated based on the NOI.
Yeah,
And you
based on
consider
the
that.
price. Yeah, so you divide the NOI by the price of the asset.
Yeah, if you buy full, right? That's the cash price. Okay.
Yeah, or at any price, at whatever price you buy it,
Okay.
right? So
Okay.
that's it's cap rate is unlevered returns, so returns without debt.
Yep, that's true. Yeah.
That's what the technical term of that is, right? And so then there's market cap rate, which is determined by the trading that's happening in the market.
Can you repeat that, what you just said a minute ago?
The cap rates being unlevered returns.
Yes,
Yes, they are unlevered returns. So essentially returns without debt. If you buy a property cash, then your NOI becomes returns, right? Because there's no debt below it.
Right. Yeah. So.
Right.
thanks.
Absolutely. Yep. So yeah, OMs are great. You can get, you can get some data from there. You can get rents, you can get units, you can get occupancy, but regardless, I always ask for updated rent rolls, updated T12s, and whatever else they can give me updated, because I don't,
Just to be clear, I love all the brokers out there. All right, so big heart right here. All those save my ass once again, but yeah, we're but at least that's where napkin underwriting is just really helpful, because then you can put in really, truthfully how the asset is performing, and gives you a little bit better idea of where the asset's currently performing.
so then, once you're here and we'll look at this and look at, this, and it says 5.8. And we're like, yeah, that's not really that good for us. 2.9. And we say, okay, hey, broker guy, listen, we're coming in at high 2s right now. Is that something your seller's even interested for, about or in? And they'll either say yes or no. They'll probably say, well, if that's your final offer, then probably not, but can you come up from there? So, right. So, we typically check in with the brokers after we do a napkin. And if we're interested in the property and say something like, hey, here's where we're coming. Here's where we're coming in, you know, is that, what do you think? And, you know, they'll let you know at this point, so.
I think that's a reasonable offer based on this napkin underwriting. This looks like a great deal so far.
So did we. So did we. But hey, alas, not everyone's a seller. I learned that. Not everyone, no matter how distressed they are.
Amen.
Yeah, if they feel like they can get more for it later, they'll hold on to it. And
They're gonna be sorry if they try to sell the end of the.
Oh, I'm sure they are. They had to refi for sure. They had to refi this. It was on a floating debt, but they had to refi it and hold it. So. Okay. Next.
Well, the last few deals that I looked at and just doing the underwriting, they're just asking enormous amount. You know, the price is just like, God, it's like, some of them are like 9,000, I mean, 9 millions more,
Oh, yeah.
9, 10 millions more. It's crazy.
Yeah, we just looked at a deal like that today in Lexington, Kentucky. You know, it's like $8 to $10 million difference based on what we were underwriting compared to what they're asking. It seems like most deals right now that, you know, Aldo and I are underwriting, it's usually about $1 million spread based on where we think we could come in on it and what they're currently asking. There's been a few deals recently that, you know, have been a lot closer, and but that's just kind of.
William, did I
seems
hear
like right
correctly?
now,
You said like,
kind
it
of
was-
spread that we've been seeing.
did I hear correctly? You said the price which they are mentioning is like $8 to $9 million higher than the actual underwriting.
Then
Mhm.
our underwriting, that where we're coming in. Yeah.
Wow.
What we
That's a lot.
Correct.
think is a fair price for it. Yeah. So, Rosa,
You guys actually submitted an LOI and an LOI for that or no?
9 million? No, we didn't submit that. When it's that far off, we'll, you know, just have a sidebar with the broker and, you know, ask what they think about it. And go from there. We know it's not gonna work. So if they're desperate enough, they'll come back later. Right? So,
Perfect.
yeah.
Thank you.
Awesome. Hey, guys, this has been a lot of fun. We're at the hour mark, so we're gonna have to let it go here. But man, this has been great. You guys are an awesome audience. Saw a few of you come out here near the tail end of the presentation or the Zoom. So hope to see you guys again. And again, if you guys have any questions or have any deals you want us to underwrite, please feel free to send it our way. We'd be happy to take a look at it. So with that, have a wonderful night, everybody.
Great call. Thank you very much. Definitely be back.
Thank you so much, guys.
Bye-bye.
It's fun, guys. We'll see y'all later.
Bye-bye.